In this video, we will discuss the market dynamics that caused a slight sell-off in the market and increased the investor risk-off sentiment that we discussed last week. Let's talk stocks the urban trader's way. Good afternoon, everyone. It's the Urban Trader back again with another video, and in today's video I will be doing another weekly market recap, this time the week of June 16th to the 20th. In this video we will discuss the market dynamics that caused a slight sell-off in the market and increased the investor risk-off sentiment that we discussed last week. This week was riddled with geopolitical turmoil, Fed policy indecision, economic and retail data, as well as investor flows. On Friday, the S&P 500 finished the day down 0.2%, marking 2 consecutive weeks of modest losses. The Nasdaq 100 dropped 0.5% on Friday, signaling a down week overall, and the Dow Jones Industrial Index had a weekly performance which was essentially flat. The week started just how it ended, with ongoing tensions between Israel and Iran. In the beginning of the week, the U.S. stock prices climbed and markets rose on easing tension and lower oil prices. However, by the middle of the week, tensions escalated amongst the parties involved and drove volatility, pushing oil prices higher and pressuring volatility-sensitive stocks. The escalating conflict between Israel and Iran caused sharp swings in oil prices and market sentiment. On June 16th, oil slid on truce hopes, but resurged midweek, affecting stocks. Conversely, bond and gold-related funds attracted an inflow as investors sought safety. As the week continued, Middle East flare-ups boosted oil 13%, lifting energy and healthcare but rattling wider investor sentiment. As a result, U.S. stocks saw a $18.4 billion market sell-off amid the increased risk-off sentiment, which I believe will be furthered by the actions that have taken place over the weekend. However, investors did choose to invest $1.85 billion in tech and $445 million in materials, which signal selective buying in the market. The Conference Board, which reports on the U.S. leading economic index, reported a decrease in May activity following a plunge in April, signaling a potential slowdown as trade uncertainties and tariff effects emerge. New data shows a $200 billion trade goods decrease from May to June, with tariffs boosting customs revenue but also lifting consumer prices for you and me 3 to 5%, prompting questions about the broader economic concerns that we all have. Retail sales fell nearly 0.1%, and jobless claims increased, which shows that there may be a decrease in the demand in the American summer and vacation season, which is generally an experience where everyone likes to go outside and enjoy themselves and spend a lot of money, but with the rising cost of things, we may see a change in that this summer season. However, inflation has remained subdued, which keeps a potential rate cut on the horizon. Wall Street data indicates that investors are moving into safe haven assets like bonds and gold, as we discussed last week, amid elevated uncertainty. On June 18th, the Federal Reserve paused its rate hikes at 4.25% and 4.5%, but maintained a hawkish tone, which means that they favor a position of raising interest rates in order to fight inflation, highlighting that further tightening may be necessary. This sent Treasury yields higher and left many officials warning that inflation may remain a concern for many. This was positive for growth sectors, however, such as tech, consumer discretionary, utilities, and real estate. This is negative news for the banking and financial sectors. While surprisingly, this may be negative news for the industrial and material sectors due to the lagging inflation and trade policy issues, which could potentially cause further cost increases of raw goods and supplies. Some sectors which could be affected by the monetary policy include the energy sector, which was up 5.8% last week and benefited from the mid to late week oil price rally amid global tensions. Healthcare was up 1.3%, which often benefits from many defense activities. Utilities was up 0.33%, which signaled an investor rotation to safe haven assets. Financials were down 2.6% due to the lag from rate and tariff woes, and technology had a mixed week, down 0.7%. In conclusion, this week was defined by geopolitical risks, particularly the Israel-Iran firefight, which drove oil volatility and caused confusion in the equities markets. Domestically, our central bank, the Federal Reserve, signaled caution while maintaining rates amid hawkish guidance. However, the Bank of England held steady under a cloud of external risk. Meanwhile, macroeconomic headwinds grew from tariff-driven trade deficits and softening leading indicators. The VIX surged almost 15% on Friday, confirming a stronger sense of risk-off sentiment in the market. Some sectors to pay attention to include, but are not limited to, those I mentioned earlier: energy and healthcare, due to riding the wave of risk-off sentiment and oil volatility; utilities, which have proven safe and modest returns over troubling times; industrials, which will have select interest due to trade and monetary policy uncertainty; and technology, which will continue to rise on any monetary and tariff policy relief. I want to thank you guys for coming to another video. I'll catch y'all next time. Peace.